Hello, and thank you so much for joining us for this special Market Sense special report. I'm Heather Hedges with Fidelity. And as we're coming to you, stocks have regained some ground after that global market sell off that sparked concerns about the health of the U.S. economy. Last week's weaker than expected jobs report and some manufacturing numbers seem to fuel that volatility, along with several other factors, including questions about the future of big tech and investments in AI. So, to talk about what these most recent developments might mean for investors, we are pleased to be joined today by Naveen Malwal. He's an institutional portfolio manager here at Fidelity. Also, to talk about how her team is talking to customers about these events and some of the questions that they're getting from customers, we're joined, as we often are today, by Leanna Devine, a vice president and Boston area branch leader here at Fidelity. Thank you to both of you for all of the attention you have devoted to this episode as we pivoted quickly to prepare for this special report. And I know this is going to be a really important show for our customers to hear. So thanks for making the time.
Thank you. You're very welcome. I'm glad we can be here for our clients.
Yeah, thanks for having us.
That's exactly what it's all about, Leanna. And today is Tuesday, August 6th. So just to recap, so the S&P finished down 3% yesterday. It was about 10% off from its most recent peak, but the market does appear to be more stable today. So that's positive news. Leanna, I wanted to start out from you. First of all, I wanted to find out what kinds of questions you and your team are getting on the ground from customers. And how are you answering those questions?
Absolutely. And first and foremost, I just always want to start off by saying, I empathize with all concerned investors. Volatility can be extremely unnerving, and headlines certainly spark concern too. And this is when investing feels challenging, and it's when our emotions play a part. So at the core of our clients' thoughts and questions, it's really the worry of being able to keep the planned goals that they have. So as an example, a few clients on my team reached out to, they're planning to retire in the next few months. And the main concern with market setbacks is that question of still being able to retire. And how we respond is really, we've been witness to scary market events. Just to name the last 4 years, it's been a global pandemic, overseas conflict, high inflation, banking liquidity events. All of this has stirred volatility and emotions, but the markets over the long term have been favorable. And volatility presents a great reminder on the importance of remaining disciplined. And despite the long-term favorable trend, it is really important to notate that intra-year declines are very normal. And so just a slide for those watching, just to illustrate how normal they are, we can see here since 1980, the S&P 500 has delivered positive annual returns 36 of the last 44 years. It just shows that clear upward long-term trajectory. But there's many intra-year pullbacks exceeding 10% in that time. So our clients, that we partner with, those that have a sound financial plan with an emergency fund, protection in their plan to help navigate some of this volatility, and having a diversified investment strategy, one that's disciplined, one we call all weather, they're really able to stay invested and disciplined during times like these.
And Leanna, you and I were talking before the show. So our team did a check on how many of these special reports we've done since Market Sense began in 2020. And we've done 5. This will be our 5th one. The pandemic, geopolitics, regional bank liquidity issues. Those have all been reasons that we've done these special reports. So to your point, these events do happen from time to time.
It does. It shows how common, while unsettling, how common these events can be.
Exactly. And that's why the reassurance from a professional like you is so valuable, Leanna, when times like these do come upon us. All right, Naveen, thanks for your patience. Let me ask you, first of all, what I imagine is a question today on many customers' minds. Is the sell-off over? Could there be more to come? Could this just be wave one? And is this the start of a bear market, or is it just a temporary pullback? And could the bull market still have more room to run right now?
Sure, those are big questions right now, and unfortunately, no one can tell with certainty what is going to happen in the markets. However, we can look back at history for some context. So the chart Leanna shared, looking at markets since 1980, it's very informative. It shows us that on average, in any given calendar year since 1980 through 2023, a pullback as far down as minus 14 has actually been the average in a typical year in the market. So seeing a sell-off of 5 or 10 or 15% doesn't necessarily mean that something is wrong with the economy or some major downturn is about to unfold. In fact, in most of those cases, it has not been a major economic event or a recession unfolding. It's been more of a temporary situation. So hopefully it's the same thing here. The other thing that's helpful to think about is after every one of those pullbacks, the market does eventually come back and does go on to make new all-time highs. So the market has returned about 13% a year since 1980, and that's what the investing experience is like. Yes, you can experience those gains over the long run, but these bumps along the way can be discouraging, can get people off their plans, and that's hopefully where we can help in conversations like this.
Absolutely, Naveen. Let's take a step back and talk about why this might have happened. Why did the market sell off? Is it possible that primarily just 2 data points caused this to happen?
It feels like that, Heather. So last week we got 2 numbers that were softer on the economy. One showed that unemployment did tick up from 4.1% to 4.3%. We also saw some softening in manufacturing activity here in the US. A third thing I'd add is over the last few weeks, we've seen a lot of big growth companies, a lot of them technology selling off. Investors have moved to other parts of the market. I think a lot of that stems from investors taking a closer look at earnings reports and seeing these big expenses to develop artificial intelligence and other technologies. And some are just wondering, when is this going to pay off? So all of those kinds of considerations around the stock market, around the economy, I believe that's what's led to the volatility we're experiencing right now.
So potentially several different factors and not just those 2 data points. There may have been other factors at play too. Still, though, the alarmist headlines can be hard to block out. And it might be causing some investors to continue to feel concerned. So how have you and your team been managing client accounts throughout this, Naveen?
Yeah, so I'm part of an investment team that manages millions of accounts here at Fidelity. And as we normally do in these instances, we are being patient and not reacting too quickly to near-term volatility. What we seek to do in these moments is assess what's happening with the earnings, because that's a powerful driver of stock market growth over the long run, and what's happening with the economy at large. On the earnings front, I feel like the story is still pretty good. We have good earning results for the second quarter. Out of the S&P 500 companies, nearly 400 have reported earnings already, and earnings have grown by about 11% since last year, which is tremendous growth for these companies on average. Not only that, but industry analysts are expecting earnings to grow further in the third and fourth quarter this year and into 2025. So all of that is a potentially supportive backdrop for stocks going forward.
Okay, that's really reassuring to keep in mind that earnings are also one of the biggest drivers of stock returns. It's not just what we see in the headlines. And Leanna, speaking of the headlines, we have seen a lot of headlines in the past couple of days about recession concerns. So how has your team been responding to those headlines? And have you been getting questions from customers about recession fears?
I know it's in the headlines, and fortunately, we haven't had clients, sharing the concerns of a recession. I will say at the core of client questions and concerns, again, it's just that ability to be able to still pursue the planned financial goals that our clients have. If it's you're in retirement and still being able to live the lifestyle, or you're close to a life event, will these market fluctuations or events impact that? And again, while volatility is normal, we talk through strategies with our clients so that they feel comfortable and confident and be able to navigate, any of these events. So just a few strategies to talk through. First, it's having that plan, a true financial plan that you can stick with. And when you pick that investment mix, it needs to be aligned to the goals that you have and your time frame and your risk tolerance, and looking at your full financial picture. And I'll repeat, one that you can stick with through market volatility. A second strategy we talk through, and Naveen's team does this, phenomenally, but it's rebalancing, and it's being able to invest consistently even in bad times. And it's just a reminder, some of the best times to buy stocks have been when things seem, really bad. And then lastly, it's just staying invested. So Naveen just shared being patient and not reacting to near-term volatility. We know that the disciplined investor has been rewarded by staying the course.
Leanna, part of what might be fueling some of these headlines about recession concerns, might be some news reports that the shift in unemployment figures and also the yield curve uninverting could potentially be signals of a recession. So Naveen, could you answer for us, what do you think about these signals? Are these types of signals, the unemployment figures, the yield curve, worth watching?
I do believe they're worth watching. I think any signal on the economy can be helpful. Where I try to avoid the temptation is just leaning too much into one signal. So I've seen some headlines come out that are saying this signal is flashing a warning sign on recession. I think for someone to take one part of the economy and run with that into a dire conclusion might be risky. What I prefer to do is my team and I work with a lot of other teams across Fidelity, including the Asset Allocation Research Team, which does a ton of economic research for the US and countries around the world. And they allow me to look at a whole range of information. So beyond just the yield curve and beyond just unemployment, and they also focus on things like consumer spending, on the outlook for profits, what's happening with valuations. What are central banks talking about? So there's a lot that goes into what is going to happen with the economy and where the earnings story might be developing as well. To me, it's sort of like thinking about the weather, right? So on the one hand, you can just take a look at the current temperature, and that gives you some sense of what the weather might be like. But I think I prefer to have a broader range of information, right? Knowing the humidity level, the chance of rain, how windy it is, all of that can help. So in a similar way, I prefer to have more information to work with rather than just leaning on one indicator as a buy or sell signal.
Okay, Naveen. So you and many of our Fidelity professionals, including another Market Sense regular, Urian Timmer, believe this does not look yet like the start of a recession and that the economy is still growing. So what are some of the indicators that you are following? What are some of those other weather barometers like you mentioned?
So let's take the unemployment number, right? And this to me is really interesting. The number did tick higher. It was 4.1% last month, and now it's at 4.1%, so 4.3%, excuse me. So yes, a bit more unemployment out there. Yet the long-term history of unemployment in the U.S., the average since 1950 has been more than 5.5% unemployment. So by that metric, we still have a very strong job market. So not only do we have plenty of jobs, I also see measures of consumer spending are positive. People are spending their money, and wages are growing at a nice clip. Wages are growing faster than inflation as inflation has come down considerably. You put all of that together, that feels like the kind of experience that could lead to further economic growth here in the US. I would expect a recession to have more dire results across all of those areas, and I'm just not seeing that right now.
Naveen, how about how the Fed might react to all of this? It's still early. We don't have a Fed meeting coming up until September. There is a chance, though, that the Fed could hold a very rare emergency meeting before September to cut rates. It is within their power to do so. So do you think the situation could warrant that? Or do you think the Fed might consider cutting more aggressively in September than it otherwise might have?
Right. Those are definitely two options. Up to this point, the Fed has come out and said that they're not looking to rush into the situation. They're still very closely following inflation and the job market, and they don't feel there's a rush to act. And perhaps it goes back to what I was just talking about with unemployment. Yes, it's a bit softer, but still a very strong job market. But to your point, Heather, if the situation between now and September were to evolve and become more of a challenge broadly, then I think it's reassuring to know that the Fed does have things it can do. So one, it could decide to act before September. So have an emergency meeting. Those are exceedingly rare, but the possibility is there to act before the next meeting in September. And the other thing they can do, they typically cut by a 0.25 percentage point at a time. They could cut at a faster pace. So that's just two things they could do. There's other things in their toolbox that maybe will help as well. But to me, the big picture of the Fed is just one of reassurance that knowing the central bank is closely paying attention to these developments and that if they need to act, they know what to do to step in and try to help.
And of course, if they decide to cut more, decide to cut even further, that would affect customers and consumers in terms of mortgage rates, car loans. It could affect their bottom line in many ways. Let's talk about a potential silver lining of what just happened for investors who have diversified portfolios. And we hope everybody watching and listening has a diversified portfolio. Of course, I'm talking about bonds. So bonds are not taking a hit like stocks. In fact, Treasury yields have fallen and also, they've risen in price treasuries, which of course is the role that we hope treasuries will play and bonds play when the stock market is going down. Leanna, I'm wondering if you feel sort of vindicated right now because you come on Market Sense and are always trying to impart to us here about the benefits of bonds. So I want to give you the opportunity, first of all, to do that again and talk about the potential value of having a bond exposure at a time like this.
Sure. It does feel good to talk about bonds now as a silver lining, Heather. But at the core, we always talk about why we own bonds, and they're really set to provide both income and stability. And Jurrien Timmer, our, director of global macro and comment on Market Sense, but he shared just today, bonds are now zigging while equities look like they're zagging. And that's, often can be the role of bonds. But bonds were significantly challenged, especially in 2022. But we've maintained that strong belief that bonds provide important diversification benefits. And just from June 30th to the end of last week, the aggregate bond index was up 4%, while the S&P 500 was down 2%. So we're seeing the purpose and role of bonds there for stability. So we'll see what happens today and the weeks ahead, but we do know that diversification across both stocks and bonds can really help soften the blow during volatile times.
Bonds are zigging, equities are zagging. Jurrien always has a good, anecdote or analogy. So it's a particularly good moment for bonds, is what you're saying, Leanna. And, while investors might think this might still feel like a risky time for stocks and they may be nervous about the markets, Naveen, I know your team sort of has a different way of looking at these kinds of pullbacks. So how does your team view this moment?
Yeah, so one way of looking at these sell-offs is a moment of unnerving emotions and wondering if you should wait to add money to the market or maybe even take some out of the market, which can actually take investors off of track from their financial plan. A team like ours, we've been doing this a very long time, and we manage these accounts with a long-term point of view. So there's a couple of examples of things I can share. So one is, Leanna mentioned rebalancing. So rebalancing means when you see a market dip, look for opportunities to perhaps buy back into stocks. And historically, our team, when there is a market dip, will assess the situation. If we feel the economy is still relatively stable and the earnings outlook is still relatively constructive, we may then at that point buy more stocks after they've sold off. And over time, that can modestly add to investment performance for investors. Another opportunity might be for investors who have taxable accounts. So these are accounts that are not retirement monies, but where you pay tax on the gains you come up with over time. Here, if you have investments that are now sitting at a loss, by selling off those investments, the tax code allows investors to use that loss to help lower tax bills either later this year or in future years. And that's something else that my team and I do regularly for our clients, so they don't have to worry about this day to day. But these opportunities can come up at any time, not just the end of a quarter, not just the end of the year, and they can add value as well. So I would just bring those as two examples of the kinds of things investors can do, or as potential opportunities for investors when there are market sell-offs like this.
Okay. So as you know, Naveen, our planned topic today was supposed to be AI investing opportunities outside of tech stocks before we pivoted. And we are going to cover that topic next week. So if anybody was hoping to tune in for that topic, we'll talk about that next Tuesday at 2. But I do want to talk about what these recent events could mean for tech stocks. So even if the bull market not over, like you said, could this potentially be the end of the bull market for tech stocks? Where do tech stocks go from here after this?
Right. So technology stocks, a lot of the big popular names out there have come off quite a bit from their highs. Some are down as much as 20 or 30%. And I believe that's been part of the jarring experience for a lot of investors who see these names in the news or in their portfolios day to day. This does feel like a jarring pullback, yet the other thing my team and I get to do is talk to other fund managers at Fidelity and outside of Fidelity. And we talk to the growth fund managers for U.S. stocks. They look at this investment in technologies as a multi-year, perhaps decades-long situation, not just something that's going to happen in the next few quarters. So as much as this pullback has been not a comfortable experience for investors, the thesis on the long-term potential for artificial intelligence to potentially help the economy and help the earnings of these companies doesn't seem to have shifted in speaking to my investor friends who focus on growth areas. They still feel optimistic about the future. So that's something I can leave the investors with. I don't unfortunately know when the turnaround may begin or when these might start to stabilize and move higher, but it's hard not to believe that over the next 5-10 years, these companies may not have better outcomes going forward than they have had over the last few weeks.
Okay, and I would be remiss if I didn't mention the upcoming elections today, because we did get some big news today from the Democrats. So Leanna, I'll ask you about this because I know you've shared previously that you have gotten customer questions in the past about the election and potential impact. What do you say to customers who are asking about how to invest during an election year?
Some clients recently have shared wanting to hold off on making any changes until after the election, or many of our clients who have been more overexposed in cash and short-term vehicles because of the rate environment of just saying they want to hold off. And I hear this sentiment every 4 years, during an election year. And similar to other events, if it's political, economic events that we see happen, time in the market is far more important than timing the market. And even if we just look at yesterday versus today, it's unpredictable to try and time the market. And so this slide that we have showing just really shows an illustration. If you did sell, or if you are still on the sidelines waiting to get back in, it's really difficult to catch up. Even missing a few of the best days in the market can have a significant impact on your long-term results. So just to share a few from here, this is giving a hypothetical example of $10,000 invested in the S&P 500. And over the course of time of investing, this is showing from 1988 to the end of last year, if you stayed invested, the assets would have grown to $417,000. If you miss just the best 5 days in the market, that drops to $264,000. And it continues to drop the more days you miss. So it can be really difficult to time the market, or even just wait and see is sometimes the things that we can hear during an election year.
Well, just a fantastic, fantastic job to both of you today, explaining why it is so especially important in times like these to try to block out those headlines and just stick to your plan. So I'd love to wrap up along those lines by asking you each just to give us your final thoughts about the takeaways you would like people listening and watching this webcast and podcast to be left with. And Naveen, you can go first, and Leanna, you can close us out. Naveen, what do you think?
Yeah, I want to bring up a visual looking just at the last 5 years in the market. And on here, you'll see in dark blue is U.S. stocks at the top, light blue is international stocks, and the bottom has bonds in green. But just focus on the stock market. All those numbers started at $100,000 5 years ago. And by the end of this chart, the U.S. dollars amount is very close to $200,000. The U.S. stock market has nearly provided a 100% return over this 5-year time frame from end of June that we just passed to June 5 years ago. But the numbers are very similar from August 2019 to August 2024 after the sell-off. And over this time, we've been through the COVID-19 pandemic recession. We've been through 2 bear market corrections, which you can see on the visual. Then we're going through our second election cycle over this time frame. We experienced a lot of inflation as well. And despite all of that, we had a tremendous rally in the stock market. So this is what Leanna and I talk about all the time. Yes, the near-term volatility, the headlines, they can be distracting. They can be off-putting and alarming. Yet for the patient investor who sticks to their plan and just grows with the market over time, more often than not has experienced positive returns by being in the stock market over the long term.
I would agree. And just to share, over the years working directly with our clients, in times of volatility, I've heard this sentiment of, well, this time feels different. And Naveen just listed out all the different events that we've had. And every catalyst to volatility has been a different event, but time and time again, the discipline and the ability to stay the course has rewarded investors. So when markets are turbulent, it's really helpful to be able to partner with someone and just talk through some of your financial concerns, going through your analysis and putting together a sound financial plan. Just know that we're here to help. So you can call us, you can go to our website, you can download our app and reach us that way, but we are here to help.
It might feel different in the moment. People might say this time feels different, but these kinds of moments rarely are truly different and rarely are cause for alarm. And being a patient investor pays off is what I'm taking away from that. All right, we've got to leave it at that. But a huge thank you to both of you for, like I said, really jumping in yesterday and helping to come up with the questions that customers were asking you and try to reassure everybody watching this webcast and podcast. This has been so incredibly valuable. And hopefully our viewers and listeners, are feeling better after hearing your fact-based, level-headed research and charts and information and take on what is going on. Leanna, you mentioned to reach out. I also wanted to mention we have a brand new Market Sense email where people can reach out to our Market Sense team as well and let us know what's on your mind. We always want to hear what questions you're thinking about so that we can help to answer them and they can help to shape the topics for our future episode. So that email address is marketsense@fidelity.com. That's marketsense@fidelity.com. Finally, just a quick reminder, you can share this replay of today's show. You can watch it again, and you can access some of our full catalog of shows on YouTube. You can catch those on our website or wherever you get your podcasts as well. On behalf of Naveen Walwal and Leanna Devine, thank you so much for your time. I'm Heather Hedges. We'll see you back here next Tuesday at 2 Eastern. Take care.